All right, welcome back to the So Ready podcast. Today we're joined by Roy, someone who has over 2 decades of experience across acquisitions, corporate finance, strategic growth, and M&A for the lower middle market companies. So he's worked as an operator and an advisor, holding leadership roles and high growth telecom and entertainment companies before moving deeper into private equity, capital raises, and M&A advisory across industries of so many. So I know he's currently working at Transworld as an M&A advisor. He's been in the game for a really long time. Rory, I'm very excited to have you here. Let's get started. Give me a quick overview of your background and like what you're focused on today.
Thanks, Alyssa. So I went to USC and I came out and was a commercial loan officer in LA and worked at a couple of national companies. Those didn't go as well as I had hoped. And so I thought, well, I'm going to buy a business. So I became a broker. And I did my first M&A transaction back in, so it's been a while.
Yeah.
I never intended to be a broker, but I never found a business I wanted to buy, or just I like helping other people buy businesses. So here I am now working for the largest business brokerage company in the world, Transworld. We're 19 countries, 250 offices, 1,000 brokers, and we primarily sell smaller 5 million revenue and less businesses. That's where the 1,000 brokers are. I'm in the M&A division. There's 5 of us. We sell the larger ones. So I've handled, I started small ones and I've done large ones.
Cool. So, 86. So, 2 decades. That was a decade short, huh?
Yeah, 2, 3, 4.
Yeah, three, four. Who knows?
Yeah, it's been a long
Look,
time. Yeah,
yeah.
but haven't always worked in M&A. I've also been a CFO partner in a couple of national businesses. So part of what helps me in my role is that I've sat in the same seat as the companies the owners that we try to help exit their
Yes.
businesses.
Okay, yeah, that's great. So you're able to give perspective from like just being in their shoes. So
Exactly.
yeah, so like I know you worked across lending and operations in the M&A space and private equity. Like from your perspective, what fundamentally separates companies that successfully exit from the ones that like never get there?
So if there's one thing that I've noticed that makes the difference is the ability to control operations, understand your financials, and to get the highest value for when you're looking to exit. You need good financials, and I can tell you, most of the companies, even the bigger ones, have their financial statements, their financial controls are just lacking, especially the smaller ones. So one of the things that we do for our companies is we help them develop a financial model. And a financial model is nothing more than putting your business in a spreadsheet so that here are the revenues, here are the costs, and here are the profits. And then you can track each of the categories on a monthly basis and see if something seems out of whack, and you can catch it sooner than letting most companies wait to the end of the year. Their accountant prepares the financial statement and they'll look at, something's not right here. We spent too much money in this area or that area. We didn't get enough profit, or one of our products was not as profitable as we thought. We should have cut that off sooner. So having a monthly review of how your business is operating, that's probably the best recommendation I can give to any business owner.
Yeah. And do you think that founders maybe wait a little bit too long for their company to become so ready or acquisition ready?
So smart people in the business, when they're buying a business, what they're doing, they're buying the business and they're already looking, how do I exit this business? So in the beginning, you look to exit.
Mhm.
So what do I need to do to make it more engaging for a buyer to want to come in and take your role? So yeah, most people don't do that. Sophisticated buyers will do that. The vast majority of people don't.
Yeah, I want to dig a little bit deeper into that. I would love to kind of learn a little bit more about financial modeling. I know that that's something that you really focus on a bit here, Rory. So, how does their financial modeling have impact on their valuation?
So this is a story we were talking before. I was working at a boutique investment banking firm up in Boston, and this is back in 2014. There was a company, Blue Apron, who had started up operations in 2012, and by 2014 they had a $500 million valuation. And
Insane.
I went to a seminar, and the name of the seminar was "How the F They Do That?" And And this was really my first introduction to how powerful the financial models are. So when they had started, they had mapped out, projected out what their company was going to do for the next several years. And at the end of 2 years, they had either met or exceeded everything in their model. So their revenue was higher, their profitability was higher. They had tracked each of the categories of costs and shipping, everything. They laid it all out. So by the time they were looking for the next round of financing 2 years later, the model was deemed to be somewhat predictive of what the business was going to do in the future. And based on their the next 3 years, they did a discounted cash flow model and said, okay, this is probably the value of your business. That simplistically, and this is when I go in to talk to prospects who are looking to sell their business. This is the thing I tell them we're going to do with their business. We're going to figure out, how does your business operate? And then when you're looking for a buyer, the typical way to value a business is to look at the last 3 years, put side by side financials, figure out the EBITDA, do an adjusted EBITDA, then maybe do a weighting for the last 3 years and put a multiple on it. And they go, okay, that's the value of your business. But that's looking back 3 years. And the buyer's not buying the last 3 years. They're buying the next 3 years. But most people don't show them or tell them or give them a hint of, here's what's coming up. If you're running your business and investing in it and you have plans for the future, you know what the next 3 years should look like. And this is where we use the model to make a projection in detail about, here I've made investments in certain assets or programs or services, and here's how it's going to benefit my business for the next several years. So when the buyer comes in, they're going to pay for what was there, and they're going to give the buyer, if you negotiate it well, they're going to give the buyer some part of the future value. And this is the difference in how we do better for our clients.
Yeah, yeah, and just to kind of dig a bit deeper, I know for those people who are watching, like a discounted cash flow model is really where you think about a dollar today is worth more than a dollar tomorrow, and you're using the expected revenue that's going to be generated in the future to help with the valuation currently, and it's just used. It is the discounted dollar, and so then they can expect a return in the future as a buyer, right? Right, Roy?
Exactly. So, right. If you say you're making $100 this year and $100 next year and $100 the following year, if someone wants to buy that future income stream, what is that? Those next future years, what is that worth in today's dollars? And so
Yeah.
there's a discount rate that you use or is implied, and it comes up with a today's value.
Yeah, of the future monies. So
Right.
cool. And how does reoccurring revenue and ARR, how does that affect that valuation drastically? I'd love to hear that.
Drastically, as you say, it's drastic. Yeah, if you have recurring revenue or contractual obligations for future revenue, much better than companies that either wait for the revenue to walk in the door or they do it on a project base, which is still a good way. But buyers highly value the ability to have some certainty of that the company is going to survive and do well into the future. Most companies don't have that. Half the companies don't have that. So half the companies are normal. They do projects and they do one project after the next. Like in my business, we're one project after the next one. We don't have recurring revenue. We just sell one business and look for another one to sell.
Makes sense. Makes sense. And so, like figuring out a way to position some sort of reoccurring revenue into your business model could drastically impact your valuation or what a buyer is willing to pay for it.
Exactly. Like if you have a pool business, so
Mhm.
there's one thing if you just service the pools. It's another thing that you have them on a monthly payment plan where for the next 12 months they've signed up for 12 months. You're going to service the pools for the next 12 months, or any type of other business platform.
Oh, yeah. And so, Roy, from everything that you've seen across your career, I would love to hear a story from like the one of your like the transaction that caused the most experience for you, where you really felt like you learned the most. I know you shared the Blue Apron story. I'd love to hear one maybe from early on in your career that really changed the trajectory of where Roy is today.
I sold a toy company north of Boston, and it's Schilling Toys. It's a national company. Three brothers owned it, and what was funny is everybody who has kids has a Schilling toy. And for forever, they wouldn't put their name on the toy. And when we were first looking at the company, he says, "Well, how come you don't have your name on the toys?" Like, "Oh, we just, we just didn't want to put the name on there." But most everybody puts their name and broadcasts it. So some of their toys, it was hard to know it was a shilling toy.
Huh.
So we ended up selling it to, it's not a private equity firm. It's a BDC, business development corporation.
Mhm.
Instead of private equity firms put equity into a business, and by buying equity and leverage, and then the company that bought this one put debt on the business. And the way that company makes money is by their target company servicing the debt. So it's a little bit different of a setup. So this is a $3 billion BDC. The Gladstone companies, I'm sure I'm way past any confidentiality. And so large corporation, and in the sale of businesses, the larger the buyer, the larger the law firm, and the more difficult it becomes. So they had a New York law firm, a DC law firm, and they're all making more than $1,000 an hour. And they had the most incredible purchase agreement, that terms I had never heard of before. And I've been doing it for years. And it's like, whoa, I think they have all these terms, and you can find these terms. I found a resource that both had all the terms and how they should turn out in negotiations. But it was months of negotiation at the law firms. There would be several attorneys on at one time and their assistants. So there was, the 1,100, 1,200 for each attorney, plus 500 for the closing cost for that one business was $1.3 million. We'd spent so much money. So it was an incredible learning experience. And I can
Yeah.
remember it was one Wednesday night, 1:00 in the morning. We're all on a conference call, yelling at each other, burning at $10,000 an hour. And I said, "That's it. The deal's over." And of course, we closed right after that.
Yeah, no, that's an amazing story, and a bit funny parts, but I could only imagine in the moment you're like having to figure it out as you go.
As you go. So yeah, that one required the most amount of negotiation and knowledge and ability to close. But we closed it. Very good business, and it still goes. And I know, so the buyer was an unfunded sponsor. So it was a buyer that was not part of the private equity firm. They brought in the Gladstone companies to supply the debt. And this is now a more that was not as typical back then. There are many executives that they've timed out of their jobs, but they still have time they want to work, and they may know sources of income, so they go individually looking for businesses to buy. So it's become much more common now that these unfunded sponsors are business buyers. They have a lot of business experience, and they have someone behind them that's putting the money up to buy a business.
Yeah.
That's like insider M&A talk. I'm not sure you need all that.
No, yeah, I mean, that's cool. I mean, it at least, exposes some of the listeners here to different opportunities if they were in that position and they were looking to maybe, purchase a business, but, now they know, to go and take a route of a BDC if possible.
BDC or private equity. Yeah, or their family offices will do it, or private equity. They basically, they have a champion that they're willing to support in the acquisition of a business.
Yeah, yeah. So you be a star, right? And so, how does someone become that star? If someone is building and scaling a company right now, like what should they realistically prioritize over the maybe next 12 to 24 months if they want to build a company that buyers actually want?
So was the question, how do you become that champion? Eh,
Well, yeah, one, I would like to know how do you become that champion that someone's willing to invest in, but then after they get it, how are they even positioning it to exit?
So it turns out so this unfunded sponsor also has, one of the categories is a search fund. And
Mm,
many times the search fund is someone who's fresh out of college, just got their MBA. And while they were there, they had somewhat distinguished themselves. They had talked to private equity, or somehow they have connections where they're considered a good risk going in to buying a business, and they go look to buy a business like right out of school, and they're learned from a book perspective, but which is not the same as actually the experience of running a company. But they quickly become experienced. And of course they have the people who gave them the money also help them along the path. And
Right.
then what to do once you're in running the business, God bless you. There's lots of entrepreneurs who have, it's their heart and soul goes into it, and there's no vacation. They are always on the clock, because if something's going wrong, they're the ones that have to make the decision. So there's many times where we have sellers who, they're selling just because they just don't want to be on the griddle all the time. They want someone else to take over the back office, take over the employees, take over the insurance and all the little details that go in. So many times when we sell a business, the owner stays on. The bigger entity takes over and does all the back office stuff that they really don't like doing, and they keep the owner on for some period of time. And the owner only has to do the part that they like to do, which is the sale, or go out and talk to the customers.
Yeah,
So
it's so structured in like a seller finance type of way.
yeah, it once someone has done all the work to get it up and running and profitable, that's what the private equity firms look to buy.
Uh,
They like to buy a race car that needs gas.
Yeah,
They don't want to buy a race car that needs an engine and wheels, right? So
of
once
course.
once you actually have it up and running and it's going smoothly, the private equity adds the gas and helps bring it to the next level.
Yeah, makes sense. Makes sense. I know you worked with a lot of different companies, different sectors, different stages. I want to hear your perspective on how founders are really confusing revenue with actual enterprise value. And is that even something that you're dealing with now, the type of businesses or the stage of businesses that are at right now that you're dealing with day to day?
So, that's a big question. It's hard to understand the valuation of your business many times, for you, because you're in it and it's your baby, right? And if someone asks you, would you like to sell your baby? Well, no one wants to sell their baby. But if you ask someone, would you like to make baby bigger, faster, stronger? Then everyone's happy to hear that. So it's kind of looking for, you can look for outside help in many ways. There are coaches, or even the private equity firms will help you along. You may not be ready to sell your business today, but they'll help you for 2 years to get you ready. And then there are companies, like one of the sister companies, Transworld, is called Exit Factor. It's a franchise that helps prepare companies for sale, and it may take 2 years from the time you sign up with them to get your business ready for sale. But they know, here are the points that need to be improved in your business to make it more saleable, make it more valuable.
Mhm.
So many times and you can read. I mean, you can read, or some people like to read, or some people like videos, and some people like a personal coach. And there's all kinds of resources for this.
Yeah. Yeah, that's great, and I'd like to kind of shift gears here regarding the AI wave, right? Do you see in the deals that you're dealing with day to day, AI impacting the current valuation or how the teams are currently orchestrated?
So everyone's afraid of being replaced by AI, but really you're not replaced by AI. You're replaced by someone who uses AI, right? So I mean, even in my role, I now have adopted AI tools that actually make my job easier, and I am able to complete things more thoroughly, better research, broader research, better description of whatever it is I'm looking up to help my clients. So I would imagine the same thing comes through in owners of businesses, whatever AI tool that you can use that helps move you along, and finding, AI's, you have to prompt the AI. So being good at prompting, knowing what you need out of AI is very good. So we take, here we take on interns every summer. And I remember I sent down a little project for them, and they gave me back the AI work that came from what I asked them to do. But they're interns, so they don't know what the end's supposed to look like. I kind of know what the end is supposed to look like. So if what they gave me back, I knew it was not right, because I know what it's supposed to look like. And so we went
Yeah.
back and I helped them through. I said, did you do this and this? You have to prompt it properly, and you should have an idea of what the end looks like, and that's experience. And of course that's what everyone's trying to get is the experience and that's why you have mentors. And I'm a mentor in our business. I help our offices across the country do M&A transactions because I know what it's supposed to look like.
Yeah, yeah, you can't buy that. You cannot buy that.
Yeah, but the problem is you have to get old before you have it all. And then, now what am I gonna do? I'm one of the old guys.
Really, I can tell. Look, no, Roy, this is like our last segment. We always do a segment at the end called the operator stack. And we ask every founder and operator this because we're actually building a data set on how top decision makers actually think when it comes to building and scaling companies. So I'm gonna run through these questions pretty quickly. I'm gonna like shoot 5 questions at you. I
Okay,
just want to hear the first thing that comes to mind. That's that cool?
that's good.
So look, the first question is if you had to double the value of a company in 12 months, where would you focus first?
Sales.
Sales. Got it.
Sales is the only thing.
Understood. Why? Why sales first?
Well, if you don't have sales, you don't have anything to work on, right? And it's only through having sales that you can then talk about the other parts of it. Well, how much did it cost me, and where are there cost savings, or how can I improve the operation? You have to start with the money coming in.
Yeah, yeah, that makes sense. Makes sense to me. Nothing else matters without that. Deals have to
Nothing
close.
else. Nothing else matters without the sales.
Understood. All right, question two. What's the most common bottleneck that you see consistently and prevents companies from scaling?
Hiring salesmen.
Hiring
No,
proper sales. Yeah.
it's you would be surprised how many companies don't have salespeople, and so you have the founder and a couple of close people doing everything. So
Yes.
this is the thing about the difference between working in the business and working on the business. You need to be working on the business, not in the business.
Yeah, makes sense. Makes sense. And I'll go to three here. So when you're evaluating leadership, teams or operators, what's one signal that immediately tells you that someone's A plus talent?
Longevity of the employees. It's if you have high turnover, something's wrong. If you have,
Mm,
very long, like in Transworld, everyone's been here forever. And the reason is once you come to work at this place, it's friendly, supportive. They do everything right to get you to stay and to do the best thing for the clients. I've worked in other boutiques. I've worked in several other boutiques that are toxic and they're not doing the right thing. And people leave
yeah.
and they don't do the right thing for the client. And they don't excel and they don't survive.
Yep, yep, that makes sense. And I really wanted to hear from your perspective of if you're looking to hire A plus talent, how are you able to decide, and what factor, what filter really separates those who are A plus that are not?
Mm, that's yeah. I mean, this is the problem everyone has. It's very hard to hire people. It's very hard to hire talented people because many times you just don't know. It's the ones that come in and willing to work hard. And there's nothing really that replaces working hard, and you have to put the effort in. Just putting the effort in doesn't mean you're successful. You need to be able to learn and adapt.
Yes.
And so you may have to go through several people to get to the place where you have good people.
Yeah. Make sure that turnover rate isn't too high though.
Yeah, so in the front end, the lower wherever the hiring end is, there may be turnover there just because you need to find the good ones,
Right.
and many times you really can't tell it. And someone who looks like has the person in my position before me had an incredible resume, and he was not good. Now I'm in happy. They're happy with me, but they didn't know. I mean, this is a big company, and they know the business, and they thought, oh, this is the greatest guy. No, he was not the great guy, and he was a disaster. So hopefully, what you do is you quickly find out if someone's is capable of doing the work and they work hard and they're willing to perform. You try to get if the bad ones out as soon as possible and the good ones you support.
Perfect. Two more questions for you, Roy.
Okay,
So when you're making a high stakes business decision, what's the first principle or framework that you rely on? Yeah.
it's a
It's
good
and
one.
you seem like a high level decision maker, so this
Uh,
this is a really good one for you.
yeah. So honesty always is the best policy, and you need to have confidence in the people you're dealing with. And if during a process someone has indications that they may be not as forthcoming or transparent, that helps me make a decision on them business or whatever. It's the ability to speak plainly, speak honestly, and and move forward with common goals.
Yeah, I love that. I love that. Lastly, what's a mistake that you see founders repeat over and over again that costs them the most?
Yeah, it's back to the financials. They're just
And if
not keeping track of their business, and you need to have a at least a monthly review of where you are.
Yeah, yeah, and I think, startup founders, they have a really hard time doing that, like, at the beginning, it's just so much chaos, and they're operating and doing everything, themselves. They're the key man, and what advice would you have for them to be able to keep those things together, put a Band-Aid on it, and wrap it up?
Yeah, no one likes doing it. No one. It's the numbers part is not the fun part of any business. But you need to know your numbers. And even if you have someone, a trusted advisor that's doing helping you with the numbers, you need to make sure they're doing the right numbers, because we've
W
seen, unfortunately, we've seen a lot of the trusted advisors are not so trusty.
Yeah,
Yeah. So again, it falls back on whoever the lead is. It's their business. They need to know the numbers, and at least once a month go through them.
yeah, you have to know the numbers to grow the numbers.
Because
That's
what's
what
the
they
what's the point of doing it? If you're
Yeah,
running 100 miles an hour and you think you're doing all this great stuff, only to find that there's a hole in your bucket and it's leaking out faster than you can put it in.
yep, yep, exactly, exactly, and you don't even know where the hole is, so you can't patch it.
Right. You have to be like, identify, you know, how it comes in and where it's spent, and that you're making a profit.
Yeah, got it. Well, no, Roy, that was strong. I really appreciate you breaking that down. This was extremely valuable, especially your perspective from both the operational and the transactional side of the business. So I think a lot of founders spend years buying companies without fully understanding what actually drives enterprise value or even buyer interest. So you brought a lot of clarity to that today. So for anyone listening, we'll link everything below so you can go check out
Uh,
Transworld.
Happy to take calls, and I'm the repository of information in the company.
Yeah, I can tell, Roy. Thank you. It's been great. I appreciate you coming on today.
Thanks, Alyssa. It's been fun.